Hi guys, I'm here with my beautiful little girl, Joy, my princess. Um, but shorting gold, I think, is a really great opportunity here, um, and actually almost a requirement, I would say, in a portfolio, because there is a small chance. Is it small? No, it's actually 50-50. A decent chance uh, that the market's correct. Um, not to make, not even to test the Corona bottom, not to make a new low, but just to correct a bit. Nothing goes up in a straight line, and it sure has gone up in a straight line. If you look at the S&P 500, the stock indexes, gold, crypto, everything has gone up a lot since the bottom in March. Um, and during such correction, everything tends to go down together, except for bonds, interest rates. But gold and crypto and stocks seem to be all very correlated and all go down together, which would cause a problem in my portfolio, for example, because I am using leverage and I would get a margin call likely. Um, and how can I avoid that? Well, by shorting gold. Okay, I could short stocks also, or buy puts on put options on stocks. But I don't think it's wise to short anything that's part of a long-term bull market, and stocks are in a bull market. Huh? If you know this chart here from me, great chart. Um, Long-term cycles. Huh? Gold, boom, bust, but we're only halfway here. Likely the gold bust and commodity bear market will last another 10 years and find a bottom, not where we are today at minus 3% return over the past 10 years. Gold, even with returns of this year included, after inflation, it was still negative for the past 10 years. But it can go a lot more negative than minus 3%. It can go to minus 6% as it did in the 50s, or minus 8%, and it can do even minus 10% as it did in the 90s. So likely the bottom will be deeper for the bear market of commodities and gold, and we're only halfway. Inversely, stocks, people say that that's in a boom, that's topping out, but average returns of stocks are only 2%. I haven't updated this in a month or 2 months, but I don't know. This is the global. That's not the S&P 500 I'm tracking here, but a world index. Maybe it's not 4%, but 10% today. Then still, we're or 6% or 8% for the year to date. But then still, we're only at 2% returns the past 10 years for stocks, which is very low. The peak of a bull market is not 2% after inflation, but 10% after deducting 5% of inflation. So that's 15% before inflation, 10% after. That's the peak of the bubble, as it was in the gold in the 50s and golden 60s. It peaked out at that return, and in the 90s also it peaked out at that return. So we're not even close to the top of a long-term stock bull market, but we clearly have seen a big bottom in 2008 that we're still crawling out of. So how did I get to this? Let me go back. What's the potential here? If you look at gold, shorting gold, what are the potential returns? Well, for example, you can short GLD, the ETF fund. Where will we likely go over the next 2 years when the market continues to be bullish for stocks, and the fear fades away, and fear assets such as bonds and gold get out of favor again. What's the price target for gold? Well, the last 2 years it went from 120, the GLD fund, to 100, peaked out at 190, but now it's back at 170. We can go back to 120 in 2 years' time. Huh? That's a realistic target. Huh? We went there in 2 years. We could go, it took 2 years to get from 120 to, actually only 1 year and a half. Huh? It took only 1 year to come from 120 to 170. It can take also only 1 year to go back to 120. Huh? But let's take 2 years. Huh? So that's a drop of 32% from today. And if you're shorting, that means it's a profit of 32% that you can potentially make if the GLD fund falls back to 120. And so if we put that into the Kelly calculation, how much should we allocate? Well, what's the potential loss here? It can go up also, GLD fund and gold. Some people believe that we are in a bull market for gold and that the all-time high is broken. That's the strongest evidence, and that's true. We did break the all-time high of $1,900. We went to $2,000. And if we are in a bull market, that means that we'll set an all-time high again. A new we already did, but we will go considerably higher. And so how high is that? Well, for that I made the chart of the gold price over time, inflation adjusted, deducting real inflation. But I made a little mistake. I estimated real inflation too high here, and due to that, the price of gold in the past is too high. It wasn't 40K. Likely it was somewhere between 10K and 20K per ounce in the 20s. That's 100 years ago. Gold was valued a lot higher, but it has gone down a lot in value, probably from about 20,000 to around $200. And then we had at the end of the golden 60s, and then we had a decoupling of the US dollar from gold standards, and gold started to be the Fed and many central banks stopped dumping gold at very cheap prices because they were almost out of gold, and started trading in a free market, and the price jumped up together with the commodity bull market. At the same time, in the 70s, gold went up and set a high of 4,000, which was a lot lower than the previous high of 10,000 or 20,000 in the 20s. Then we had a bear market in the 90s, 80s, and 90s, and gold set a low of $1,000, inflation adjusted. This is always inflation adjusted. Then we had a new bull market in 2000, and we set a high, but always a lower high. This time not 4,000, but 3,000. Huh? So you can see here it was like 20,000, 4,000, 3,000. The next bubble in gold, bull market in gold, well, if there is one, it will likely not go to 3,000. Huh? Joy, can you be quiet? I don't want to hear you. Huh? Um, 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 there is a clear trend here. That is that, yeah, every bull market, gold goes less high in valuation. And there's another trend here, and that is that though the chart may show, look, we also have higher lows here. Every bear market, there is a higher low. But I don't think that's the right way to read this. I think that if you look at inflation adjusted, this was an extreme situation. Joy! The price went much lower than would happen in a normal market because, well, central banks had confiscated all the gold in the 30s, and pure theft. The United States Central Bank, the Federal Reserve, confiscated all the gold, and of course, due to the World Wars One and Two, many of the Europeans, as well as their central banks, lost their gold stash, and the United Kingdom lost a lot of their gold due to, well, making war. It's a costly affair. And most of the gold ended up in the American central bank. That got liquidated by the Fed over the years due to the gold standard. They said that an ounce of gold was worth $32, and if you don't believe it, well, you can buy it from us for $32, and that's how they lost all their gold, at $32 over the course of 50 years. Of course, yeah, if there's such a massive dump of gold in the market, that will depress prices. And of course, inflation is rampant also during that time. And so $32 in 1930s may look like was still a reasonable price considering supply and demand, but not after 40 years later. $32 is a lot less expensive than it used to be because the dollar inflates away in value. But if you take away this extreme high valuation and this extreme low valuation, I think what you will likely see is that, and it corresponds with logic, is that the value of gold slowly goes down over time, that the booms used to be higher, and that even the bears used to be higher too, with the exception of this one. And that, just like with any commodity, the value in the long term goes down, but especially of a commodity that is losing its utility. Gold was valued not because it's a useful commodity to use in electrical appliances, for example, or in photomaterial, or in or as a, I don't know, conductor of electricity or a reflector of light. That's not why gold was valued. It was valued for its use as money, and it was valued very high for that, because it was the best money in the world for 400 years, since 1600. But it gradually lost its value as money um, because it wasn't as good as money as the new technologies and new inventions such as banking credit. Yeah, people figured out in the 1800s that actually, instead of giving each other physical gold, well, why don't we just write a note that, hey, this person here can get a piece of my gold that's stored in the bank. Bank notes, bank promises, and people start to pass these to each other, and the bank formalized these notes, and that became basically paper currency, and it represented a gold in the vault, that you could claim it for gold in the vault, in the bank vault. And people preferred that over carrying metals in their pockets and storing metals at home. They prefer to carry paper and store paper, and leave the trouble of carrying all that weight to the bank, and storing it safely. And of course, from time to time, commercial banks, would default on their paper promises of gold, and would issue more paper than they have gold in the vault, and the government start to figure out, like, hey, that's actually a very good business. You print more currency than the gold you have in the vault. It's creating money out of thin air. It's a golden business. Let's get into that also, and let's monopolize it. Let's forbid that commercial banks do this, and only we as a central bank can do this. And that's how you had the creation of the central banks. They monopolized the very lucrative business of issuing more paper currency, and promising that it stands for, you can redeem it for gold, but in reality you can't. There's not enough in the vault. But okay, people still prefer to use that over the actual physical gold because it's more practical, and the bill gets paid only irregularly, only the idiots end up paying the bill of at the beginning commercial banks going broke because they didn't have the gold in the fold. Well, only idiots were left with the paper promises, because the smart people, they would dump their paper currency when they start to hear the rumors that a certain bank is not good for its promises, is likely going to default. The smart people get rid of their currency promises, and only the stupid people hold the bag. But the same today in the crypto world, where you have a lot of idiots holding tether currency, paper promises, but with probably an empty vault. And when the shares stop being passed, and the bank goes broke, only the idiots are left with the paper promise here, because the smart people have long dumped their tether. Or have never held it, and or only shortly to do a trade or a transaction and then get rid of it. That's how you do that. But yeah, there were other inventions also that reduced gold as the value of gold as a currency, not only banking promises, but also digitalization of currency has also reduced the value of gold, because yeah, paper is more practical than metals. But what's even more practical than paper is digital, and so uh, yeah, it just has gone down a lot, physical gold in value and in utility in society, and people use it less and less. So you see a long-term downward trend in valuation, and so upwards potential is indeed not the same heights as in previous bubbles, but less. And so that's how I come to this 2,500. That would be somewhere here. Let's say we have a bubble. Well, that would be somewhere peaking out here then. Not here, but here. So that's not 3,000, it's 2,500. So upwards potential I have here is then from today, we're around 2,000, 2,900, 1,800. Well, it can go up another 25%, and that's it. What's the chance for that? Well, I estimate that to be very low. It's only 10% chance of a new gold bull market. Why? Well, because of uh, time and supply demand production figures. What you typically see in a bull market, that I made a video on this. You can find it. I will link it below also. Production versus price, 100-year history of gold, is that a bull market only starts when supply collapses. Supply collapses. That means that it only collapses for one reason, and that's that it's too cheap. Gold has become too cheap, and the mines stop producing. It's not profitable anymore. They close down the mines, and you have less uh, new supply of gold than the years before. And so supply production, mining production, is mining is collapsing. That's always a great indicator that yes, gold is too cheap, and it's not sustainable also, because gold, the usage of gold does go up over time. As a currency, not, but it's also used for other applications. And as the value of gold goes down in the long term, other it becomes more useful for other applications. And so you see that the gold production goes up by about 2% per year on average, but it's via booms and busts. Because we become better at mining gold as we invent new technologies, such as, for example, the truck or the excavator. We become better. We start to mine more and more of it every year. But and we also need more of it. We also use more of it every year as a society. And consume more of it. So the production does need to go up in the over time. And if it does not, if the production collapses, then you know that okay, the current price is too low and it's not sustainable, because we do need more gold over time, and the production needs to be go up again. And how can the production go up? Only one way: by the price going up, by having a shortage of gold and see the price go back up. So and what you see is that when after the production collapses, the price goes up. Here the production collapses, but it takes 10 years sometimes. It takes quite long before the price finally goes up. The production collapsed here in 1910, and in 1930 the price went up. Then the production went up a lot in 1930s due to a higher price, but there was a point where it wasn't high enough anymore. Even though the price stayed the same, it was $32. In real terms, that was a serious collapse because you have inflation. 1930s, 40s. That's just like $32 becomes less and less in real terms, and the production collapses again. Also due to the World War. Here, many miners were also called to go to the war. Um, but production collapses, uh, then goes back up, then collapses here, and when it collapses, shortly after, the price explodes. Okay, due to the explosion in price, the production goes up a lot again, very long, but there comes a point where it again goes down, and then you can say, okay, this is a clear sign that finally prices are too cheap, production is finally declining, and that's only in 2000 here that it starts to decline, and then you can say, okay, this is probably it's time for a sustainable bull market. But there, in this case here, they start at the same time. The decline in production started at the same time of the rise in price. So you could say that in this case, but only in this case, um, it was going hand in hand. And so it was not first production drops and then the couple years later the price goes up. No, they did it both at the same time. So there is no collapse in production. Production was flat in 2020 due to some mines due to the COVID. But that doesn't and strikes. Some mines produced less because there were strikes in South America, and of course all these COVID clampdowns, shutdowns, lockdowns have also put some mines in trouble to produce because of just airports being closed down or people not showing up for work, or just regular politicians shutting down forcefully down all the activities. Of course, but it was still flat. It didn't drop, or maybe just a little bit. So that doesn't count. You want to see a collapse in production due to the price of gold being too low, and that's clearly not the case. The price of gold is very high, and every miner that's able to mine is making huge profits mining gold these days. So there's no declining production, which is one indicator that we're likely not ready for a long-term bull market yet. Another strong indicator is the time between bull and bear. You can see that on the long-term returns here. Wait, it's a bit slow here. It used to be indeed in the 1800s that commodity bull markets were much more frequent, every 10 years, 20 years. But this has been going down. This cycle has become longer and longer of stock bull and commodity bear. Here, for example, you see that the cycles, it takes very long here. Bull, bear, bull. The bear market takes 20 years of gold here, and we're only 10 years in. Here, the bear market, you can't. If you would count from here, for example, in 1935, the bear market of gold takes also 20 years. I were only 10 years in, 20 years here, 20 years here. It's not likely, after having a real big bull market in gold, that the excess supply is already eaten after 10 years. That's not likely. It usually, at least in the past, takes 20 years before supply demand is out of whack again, not 10 years. So that's why I think it's likely that gold will is still in a bear market, and so this bump is actually an amazing opportunity. If gold is indeed in a bear market, then actually it should not happen that the all-time high is broken, but it did. And I think it's because of this COVID crisis, Corona crisis, that this happened. Otherwise, it would not have happened. And indeed, if you look at the fund flows in the gold ETFs, let me show that. They were very high. Yeah, the flows. Gold fund flow to the gold ETFs, I assume. You can see here in the year 2020, there was a lot of flows into gold ETFs here, like for half a year, like a lot of net inflows. And we just had a first dump. The price also went down from a peak of 2000 to 1700 or so. We're back at 1850. A first dump here. But if you look at previous, well, here, this is the bubble. The bubble. You can't really see a pattern here. But here you see a pattern. There's some time that it goes a lot of inflows and then a lot of outflows, starting with a big dump, but there are many dumps after that. Price went down a lot also here after the peak in 2011, 12, 13, 14, the price went down a lot. I think it's likely we will see a lot of these dumps here in the future as people divest away from gold back into stocks. Another important chart that backs up the case for gold being in a bear market and out of touch with reality is that the gold oil ratio, okay, it's now back at 30, but it really exploded half a year ago when gold went up while oil collapsed to even minus zero. Below zero, oil collapsed the price, causing this ratio, the gold oil ratio, to explode for the first time to extreme all-time highs of 80, 90x. Gold was almost 100 times more expensive as oil. But the historical is that gold is only like 20 times more expensive than oil. A barrel of oil, an ounce of gold, only 20 times, not 100 times. So this confirmed that something is not right here, because gold always is in a bull market together with other commodities. It doesn't do a bull market on its own. And so commodities are not in a bull market. But gold goes up a lot. Who's wrong here? Are commodities wrong or is gold wrong? One of them is likely wrong and is pumping unjustly, or is staying flat unjustly. Of course, the gold bulls and the commodity bulls will say, but it's the commodities that are wrong. Gold is right to go up. The commodities just have to follow now. But I say the inverse is true. It's gold that's wrong, and commodities are right to be priced low and continue to likely go down as we just had a commodity bull run 10 years ago. And there the same story applies. You need to see supply collapse of all these commodities because the prices are too cheap, and only then you have a sustainable bull market. That's not the case for these other commodities, also not. So all strong indicators that it's likely that gold is still in a bear market, and the gold price is just out of touch with reality, and there is something exceptional that happened here. And it's the Corona crisis that happened here. This is an event comparable to a world war. It's a serious, big event that caused massive fear in a market causing a flight to safety, a flight to certainty, a flight to gold, while at the same time causing massive glut of oil, because suddenly people stop flying, like from 100 to 0. They stop flying altogether. They stop driving. They all stay at home. Crazy. Huh? That caused oil to go to below 0. And these are extreme scenarios that you only have once in your lifetime. Huh? Did you enjoy the show? I hope you did, because it won't happen again. This kind of crisis in our lifetime. Other crises may happen, but something like this will not happen again. But we will talk a long time about it, and we will continue to fear this, just like with a world war. The people that lived in a world war, they continue to stash soap and oils and in their basement because they're afraid of another world war. But it doesn't happen. You only experience it once in your life. And the next generation is still hears lots of stories about it, and they avoid a world war because they have heard how bad it was. And the same is true with crisis like this. The fallout is not clear yet, but it's clearly there. Many people have suffered greatly from the harm done here, and that all still needs to come out. And they won't do something as stupid as this in a long time to come. Um, so, yeah, extreme scenarios and extreme opportunity, therefore, too, I believe, because and nobody seems to see it. But I think this is one of the most safe investments you can do, shorting gold, because you win in both scenarios. Let's say that the fear is justified, and we get another deflationary collapse that we just had half a year ago, where the market collapses. Well, stocks will go down a lot, crypto also, but what will gold do? I will also go down a lot, as it did then. When you have deflationary collapses, gold also goes down. Um, uh, During those, it's a short period, but you saw it in 2008, when the market collapsed. And even though gold was in a long-term bull market, and had done very well the years before, but when you have an actual deflationary collapse, and the stock market drops by 50%, well, gold also drops here from 100 GLD to 75. That's minus 25% here. And after that goes up a lot. But during that time, gold goes down also. Same here in March, when gold went down, when the markets collapsed. What did gold do in March? Well, before it went up, but from 160, it collapsed to 140. That's also minus 10, minus 15%. So if we indeed get a deflationary correction, which is not likely, everybody fears that, but it's not likely. But I fear it also, because because I am heavily invested also in the markets. I believe things will go up. I've taken on lots of leverage, shorted a lot of gold, shorted bonds, invested in many things. And if we do get another deflationary collapse, I'll get margin calls. It's not a good situation to be in. So I have to protect myself against that. And actually, shorting gold is a good to do. Okay, it's better to short other things like airlines; they will drop more, or crypto. But the problem with shorting these things is that they are likely to go up in the long run. So if you're wrong, you're likely going to be wrong. However, with gold, that's not the case. It's likely to go down in the long run, and it will also go down during a deflationary collapse. So in both scenarios, like if I'm right, and indeed markets continue to go up, but in a long-term stock bull market, well, gold will likely go down. It's inversely correlated to stocks. So I win with shorting gold. But if I'm wrong and we get another test of the corona bottom, or another serious correction, or more fear coming back into the market, actually gold will initially also go down. But in that case, I have to sell my short gold. If we get another deflationary collapse, I will make in a short time span, weeks, maybe maximum a month, a nice profit on my short gold. But then I do have to dump it because after that gold will likely go up a lot. Just like it did after 2008, after the March crash, it went up a lot. But I will sit on profits that I will really need also because my other investment will likely go down a lot. So shorting gold, I think, is an amazing opportunity here where you likely will win, very likely in both scenarios. That's what I'm doing. I've started to add some puts on gold. Before I was just shorting GLD because I like that it's so cheap to short. Joy, quiet. Hey, you only pay 0.5% to borrow the GLD shares. You don't have to pay anything else. Like, for example, if you short bonds, the TLT fund, then you do have to pay also 1.6% dividend per year. That's not the case with shorting GLD fund because it doesn't pay any dividends. So it's very cheap to short this. Only 0.5% fee you pay to borrow those shares per year. And the proceeds you get from borrowing those shares and selling them into the market, you can use those proceeds to invest in other things. So that's why I've been promoting this trade for half a year already, or maybe a little bit less. And I've invested those proceeds myself and made great profits on them with the airlines, especially, but also Zillow. Just 2-3 months ago that I did this trade, and Zillow was $90. These airlines were half of the price they are today. So the proceeds I got from the short gold have like at least gone plus 50% or so. So on the short of gold, I didn't make that much money. Actually, it's only a little bit lower, but it's by investing the proceeds in other things where the big profit lays. The problem with my account, however, is that I have cash that I can't even invest anymore because I reached the maximum leverage in my brokerage account, and my broker does not allow me to invest my remaining cash. So I don't need to raise more cash anymore because I can't even invest the cash that I already have. So that's why I start to look at puts instead of shorting GLD. I just buy puts because I only have a little bit of cash left that I can invest, and I don't need to raise more cash. And so puts on gold make a lot of sense for me then, because they will also, in case we have a deflationary collapse, they will go up a lot more than just shorting gold. For example, I really like this put. It expires already in 1 month, and it's a put at $160, but it's very cheap. It's $0.50. And so the market thinks that it's very unlikely that gold by January the 15th, by the middle of January, the GLD fund will collapse below 160. The market thinks that's very unlikely in 1 month. But I wouldn't say that's very. Yes, it's unlikely, but not very unlikely. I mean, it is in a downward trend. It just showed great weakness, and yes, it bounced out of that. But that's actually a great time to continue to short, because now the prices are really interesting of gold to take on more short position, because it's proven that this is something is wrong here in this gold bull market. All these bulls we read, oh, we broke the all-time high here. Wow. We're in a new bull market. Yeah, but since then, it's been correcting. Stocks been pumping. The fear is fading from the corona crisis. This is not looking good. It's actually, made a video a week ago. Is it time to pile on shorting bonds? Well, I think no, it's not a time to go strong in shorting bonds yet, but it is a time to go strong in shorting gold. I believe, and so I took 0.7% exposure to this option here, a put on gold. Okay, likely it will be worth nothing and expire at zero in 1 month if it's not below 160. But if it's below 160, let's say it hits 155, I will do a 10x on this position, huh? Because half a dollar becomes worth $5. Um, a small chance to do a 10x is a good investment, huh? Especially in a scenario where your other investments will likely then, well, it depends. Like gold can collapse in both scenarios. So that's what I really like about shorting gold. Because, for example, here, when gold collapsed here, it was because the markets are pumping hard that gold collapsed. Because gold investors say, "Fuck this! I'm selling my gold. I'm going and joining the stock market." Huh? That's why gold went down here a lot in the matter of 2 weeks. Huh? 2 weeks, it went from 175 to 166. Huh? So minus 10 points here. Yeah, so it can happen while stock markets boom, but it can also happen if stock markets collapse. Huh? And I can hear it, stock market collapse, it went from 157 to 138. Actually, when stock market collapse, gold collapses harder than when stock markets pump. But that's very good, but that's because that's exactly when I need these gold options to perform strong, is if the stock market would collapse strong. Huh? So it's a great hedge also. And I bought also this other put. It's a lot more expensive. It's almost $5, but it only expires in the middle of next year. By that time, gold is very likely going to be below 160, in my opinion, because gold, if you look at the longer term, it's likely to go back to 120, the GLD here in 2 years. Huh? But in half a year, yeah, it can certainly be below 160. I mean, in half a year, we can certainly be back here at 140. Huh? I have a put at 160. Okay, I pay $5. But if it's at 140 in half a year, then I make $15. The value of that $5 go up to $20. I do a forex on my money. Huh? If it drops to 140 in half a year. Huh? You can never achieve these returns with shorting gold, a forex, of course. No, if it goes down to 140 from the current 170, you make 20%, not a 4x. Huh? That's a lot more, 4x. So these puts do make sense. I would say that the price is very cheap actually for this one that expires in 1 month. They're throwing it basically out the door. Definitely worth buying it. But I even think a put like this is quite cheap actually. Though I wouldn't say it's cheap, but it's certainly not expensive. I hope you enjoyed the video and inspires you to also do this, huh? Because that's what you need to do. If you want to profit from this, you need to do the same. And then cross the fingers that it will pay off. Thanks for watching.